Hi, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, the mechanics of cost accounting, and this video covers the Queen's Cross. So, the Queen's Cross, first thing we do is we draw a cross. Now, the top of the cross represents our balance sheet, and on the left we have assets, and on the right we have liabilities and owner's equity. So very simply, assets, this is what we've got. Liabilities, this is what we owe. And owner's equity is everything that's left over. So again, the top is the balance sheet. Now, the bottom is the income statement. On the left, we have our expenses, our losses, and any distributions that, of assets that leave the organization and go to the owners. On the right, we have our revenues, our gains, and our contributions from the owners to the organization. So a couple things to keep in mind. This is fairly straightforward. Again, the top is the balance sheet. The bottom, well, these are part of the income statement. And then distributions and contributions are part of the statement of changes in owner's equity. Since this is a course in cost accounting, at least the accounting part of the course, we really won't be talking about these at all. So I've crossed a line through them, not because they don't belong there, but because they're not going to be our focus. I've talked about the top and the bottom. Let's talk about the left and the right now. So here's where the debits and credits come in. When we put T accounts in each corner here, so let's just take a classic T account for the asset side, cash, and the owner's the right side we can call this debt. The thing to remember is that we make the account bigger when we move when we put a number on the outside. So, for example, if we borrow $100, we've got to make an entry. The first thing that we can do is we can credit debt for $100. Now, the Queen's Cross is really just like a seesaw or a teeter-totter. I've put this number on the outside, and just as a kid who sits way back on the teeter-totter seesaw is, when he sits way away from the middle, he exerts more weight. The same thing is happening here, and you can see slowly but surely this whole Queen's Cross is tilting over to the right. And the only way to get it to balance again is to put a debit somewhere. Okay, so now we have increased our debt by 100, and we've increased our cash by 100, and now we're back in balance. Okay, the same is true actually wherever we put that debit. So if I put another, let's say we borrow another $10, well, that $10 could go and we'll see now we're getting out of balance again. I've got to put a debit somewhere. It could be that I spent that money, but it didn't create an asset. It just created an expense. Let's just say it was for marketing, and I put the 10 there, and I feel better now. I can sleep at night because my debits equal my credits, and we are all in balance. Okay? So it doesn't matter which quadrant the entries go in to determine whether your Queen's Cross is in balance. You just need your debits to equal your credits. But remember, if you debit anything on the left side, It's going to pull it over to the left. You're making the assets bigger or the expenses or the losses bigger. If you credit something on the right, you're going to make your liabilities, owner's equity, revenues, or gains bigger and bring it back into balance. Okay, so now we have the basic idea. Let's go through a series of specific entries using the Queen's Cross. And as I make these entries, I'm going to focus on two questions. First, other than, of course, what accounts we're debiting and crediting. So first is, have we made our company bigger or smaller? And second, have we made our company richer or poorer? So how do we make our company bigger? Well, again, think of the kids on the seesaw. As they move out from the center, there's effectively more force pushing down on each side. That's just like, so when we borrow $100, we owe $100, but our firm is bigger by $100. We have more cash and we have more debt. Now, we're not any richer. And that's because we haven't touched the bottom half of the cross here. So anytime you put something, you know, if you're only staying at the top, then the only thing you can be changing, if all your T accounts are on the top half, the only thing that you can be changing is the size of the company. It might be getting bigger, it might be getting smaller, or it might be staying the same if, for example, you're just transforming one asset into another or borrowing from one person to pay another back. As soon as we get into the bottom half here, then we're either making ourselves poorer by recognizing expenses and losses, or richer by recognizing revenues and gains. Okay? So here's a list of 10 entries, or 10 events, and we're going to make entries for each of these. The first event here is that the company, so they make gloves. The company uses $1 of leather to make a glove. Okay, so they use up $1 of leather. And hold on, let me just find my crib notes here. We use up $1 of leather, and so we're going to have to credit a materials account. And I've just tried to keep it simple. Entry 1 is for $1. Entry 2 is for $2. So here's a credit for $1. Now we've made our assets smaller, and you can see, right, we made the asset side less heavy, so it's drifting upward. We'd better do the other side of that entry. What did we get? Well, we really just transformed one asset into another. And the asset that we got is called WIP, or work in process. And so we're not any bigger or smaller, and we're not any richer or poorer. All we've done is transform one type of asset into another. Here is our second entry. The company uses $2 of business cards for marketing activities. So I'm just going to say the business cards are part of our materials account. So again, we're making it smaller. We're crediting an asset account. The left side is drifting up a little bit. We've got to get a debit in there somewhere. And where's it going to be? Well, you know what? This time, under most accounting systems, when you spend money on marketing, you don't actually believe you have another asset. You don't believe you have something that has future economic benefit. Instead, you spent money you had to spend, and all you got out of it is you survived for a little while. So we're going to put that down here as an expense. I'm going to call it SG&A for selling, general, and administrative expenses. And we put our $2 there, and that puts us back in balance. So now what happened? We lost $2 of assets, and what we got in exchange was just an expense. We are $2 smaller and $2 poorer. Let's move on to the next entry. time cards show $3 of labor went into creating a glove. Okay, so, well, labor, we probably don't pay our workers in cash. We probably just, when we look at that time card, we say, golly, we owe our workers now $3. We'll call that wages payable, and I'm going to credit that for 3. That's making that side bigger. Where does that go? Well, we spent $3 to make a glove, so that's, we created an asset, right? We borrowed money, we created an asset. We're not any richer or poorer, but we are bigger. Entry 4, we look at our workers' time cards, and $4 of labor went into a guerrilla sales campaign. Okay, so I guess we're sending people out, handsome and beautiful people going out to wear our gloves and make them seem cool. We owe them $4 for that hard work. But we don't have an asset. Marketing expenses, we rarely record as an asset, and so I'm going to do the most common thing, and I'm going to debit SG&A for $4. So now you can ask, wait, bigger, smaller, poorer, richer? Well, we borrowed $4, and but we basically spent it all. Okay, so. Now we're basically the same, we're the same size, but we're poorer. Okay, let's go on to 5 here. The company sold gloves that cost $50 to make for $500 on account. So I want to give them some profit. We've got, when we sell, we have 2 entries that we need to make. Let's do the sad part first. Actually, we have 3 entries to make, because usually, right, when we sell our goods, this work in process, that's where we keep our gloves until they're completely done. If we sold them, we must have finished them, and so we put them into a finished goods inventory. They cost $50, and so we would credit work in process for $50 and put it into finished goods. All we're doing here is transforming one asset into another. Doesn't make us bigger or smaller or richer or poorer. But then, when we sell the item, here's our cost of goods sold account. That's an expense account. And so we're going to take that $50 out of finished goods, and we are going to put it into cost of goods sold. So now, so far, with this event, we are $50 poorer because we lost an asset and turned it into an expense. So, on the other hand, we do have good news. We're going to recognize revenue of $500 because that's how much we sold it for, and let's just say that that's cash. So they gave us $500 in cash. Okay. Now, let's assume we have a little more bad news, and some of our materials were destroyed, and so, there was maybe it was theft. So one of our employees walked off with a piece of leather worth $6. So we're going to credit materials for another $6, and we're going to call that a loss. Okay. So I just want to now clarify a couple things. You'll see that down here we have 3 different accounts in the bottom left, which we said before, just to put this up again, we said before that was for expenses and losses, but I didn't, and distributions, but we haven't had any of those. But I didn't really talk about the difference between expenses and losses. The difference between an expense and a loss is that an expense is money that we spend as an integral part of our business. So whereas a loss is a one-time event where we lost wealth, but it's not something that we expect to incur repeatedly as the way that our business makes money. So we know we have to engage in marketing in order to sell the stuff we make, and we know we have to spend money to make the stuff that we make and sell. So these SG&A and CGS, sales, general, and administrative expenses, are expenses. Cost of goods sold is an expense. Losses are losses. We don't expect them to be what accountants would call persistent. That said, keep in mind they're in the same part of the cross, so they behave in exactly the same way. So that's the introduction to the Queen's Cross. I hope you found this helpful, and I hope you'll come back and look at some more videos. Thanks a lot. Bye-bye.